Hi, it's Mike from the HomeHappy Team here with your rate synopsis for March 18th, 2026. So the Bank of Canada chose not to make a change. They've got kind of a problem. They're stuck in the middle between a slowing economy where we have higher unemployment, uh, negative GDP, and basically we're on the edge of a recession, if not already in one. And then on the other side, we have a war going on that's creating the potential for higher inflation, which they're terrified of. So they're kind of stuck. So they ended up doing nothing, which is what most people expected. However, we still feel strongly that the impact of this inflation is not going to be major. That our last inflation number was 1.8. So we have some room for it to go up, say 1%, and still be in the target area. However, the slowing economy is the more important piece to me. It's more likely that that's going to cause more pain. It's certainly causing pain in terms of we should have been dropping rates now, but we can't now because of this oil situation. So I still think the biggest focus most people are sort of missing is CUSMA. CUSMA is the North American Trade Agreement that is coming due in July, and that we haven't even started negotiating with the U.S. on. Meanwhile, Mexico and the U.S. are working on their agreement. So if that agreement doesn't come together, and it doesn't seem likely that it's going to majorly impact the Canadian economy. We'll no longer have the low tariff situation with most of our products that we've had for the last year. And that's going to impact the overall economy severely. And I think that's why the Bank of Canada is saving some room so that they can drop at least a quarter, perhaps a half later this year. Unless something changes between now and July, we think we're going to see a hold pattern until then. CUSMA will be the indicator. And then from there, going late summer into fall, we'll see rates coming down. But in the meantime, because of this oil impact, fixed rates, which are tied to the government bond yields, have gone up. Big investment money comes out of stock markets when they're scared, which is what's going on the last week or so. And it goes into safety, which is government bonds, which increases the bond yields. And that's why we're seeing increases in fixed rates, about a 0.25%. So it's not severe. It's probably something that'll probably come back down. The bond yields have already come down a little bit since then. So our expectation is that they'll bump around a little bit with the news and up and down. But generally, they're going to stay in a range of 0.25% to 0.5% of where we were. And if the rates come down with prime, if prime comes down in the fall, we'll see those rates follow down with it because the economy is going to slow down. So that's it for now. As always, if you have a question about your personal situation, because everybody's situation is unique, we definitely encourage you to reach out and we can have a quick 10-15 minute chat and make sure that your plan is keyed into what's going on. Thanks and have a great day.